everybody's having a good start to your day. Hey, we got a negative momentum event going on right now. We haven't had one of these since, well, February 21st. We have 10 sectors all negative right now. S&P 500 selling continues to blow out and weakness in the AI trade. We're going to break all that stuff down and more. As always, we will do the runner at 9 o'clock. We are not talking about QE. I'm done talking about QE. We're going to talk about negative momentum. We'll change it on the fly because we have that flexibility and we have the technology. All right, so couple people still trailing in. Good to see you, Eric in Northport. R. Moore for Jeff in Houston. Thanks for joining us this morning. Let's dig into this a little bit. You know the drill. You are here today because, well, this is an interesting market environment. We have not been in this type of environment since February, and everybody's got an opinion on this stuff. I get it. Everybody understands momentum now. Everybody's talking about the repo market. Everybody's into my bands now. Right? It's suddenly people start talking about a band that I liked 10 years ago that nobody heard of and made fun of me for. And now all of a sudden, everybody's an expert in the repo market. I welcome it. Good. Finally, people are having these conversations. But once again, we are in an environment now where it gets a little dusty. It gets a little tricky because all eyes are really on public policy. It's all going to be around the Fed. It's all going to be about what is the Bank of Japan going to do after SoftBank just got punched in the face again. Korea selling off. Lots of concern around the global market, yet no real place to pinpoint it just yet. The moves that will come today are going to be fraught with reversions. Interestingly enough, this is the first time going back since the Silicon Valley banking crisis that we have been operating in a quote-unquote negative S&P 500 environment where we haven't really seen a full and complete breakdown in the S&P 500, particularly around the 50-day moving average. Instead, we're hovering around the 20 on the SPY. It's still in the banking sector. We're obviously keeping a close eye on what's going on with the FAZ. The FNGD has not broken out. The things that we look for have kind of shifted. So it suggests to me that the cockroaches that Mr. Jamie Dimon has discussed might be still abroad, might still be in Japan. I have been warning about SoftBank for a while. But that said, hey, look for reversions, look for bounces, look for the market to move to oversold on short duration, short term, and then spike back up because a lot of algos that might be programmed around certain different moving averages, they're not going to shut off yet. So we could see a lot of volatility, a lot of wild action, and it's all about positioning on a day like today. Real quick, looking at the futures, I do just want to point this out. We're flat. Sure. We were down before. VIX is up. Bitcoin's bouncing back a little bit. Palladium's bouncing back a little bit. Silver's bouncing back a little bit. Some dip buying. But the real question is this sustainable? And I will remind you, and we're going to talk about negative momentum and what it means and how long we're even going to be here. We might not be here for another 2 weeks. We might be here for another 2 hours, and suddenly money comes back in. It's just the way things work. We operate in an environment where we get these signals and then either they crack, right, which is what we saw back in February, or it's just a simple retest of key moving averages and support. We had a big move down on October 10th. What happened? We bounced back. So we're going to keep our eyes very, very wide open over the next 24 hours, looking for directions. Once again, markets do not take an elevator down at the onset of these types of events. What actually happens is we move through a period of lower highs, lower lows, and then ultimately when we hit a point where there is no more bidding, that's where we see a squeeze. And if there is no real structure to the bidding, that's where the escalator event or elevator event will happen. This pattern that I'm talking about has happened virtually every single major event that has transpired dating back to 87, but it's especially a very important post 2020 pattern. You see this with the Nikkei crash last year as well. On momentum, we are negative, and I have been warning about this for the better part of a week. The number of stocks breaking out versus breaking down on the S&P 500 has been severe, but the reality is the breadth of this market, it has been a small number of stocks that are effectively pulling the market higher while everything else is under stress. What we really have to pay attention to is the total capital outflows. And keep in mind, the top 7 stocks on the S&P 500 have the same market capitalization weight as the bottom 422. And it's about 22 trillion each, I believe, according to the Compound podcast I was watching this morning. But the SPY reading, the NASDAQ reading, the Russell reading, all red. Russell has been red for the better part of, well, effectively a month. But again, as you see with the Russell, as we have been moving lower over the last week and a half, what do you see? It is not a straight line down. It is a pattern of lower highs, lower lows. We're going to look for, especially on the 30-minute chart, a move toward oversold on the RSI, and then look for a pop, possibly a move back up to 243. And if the continuation continues, then continuation continues. If the pattern continues, we will continue to look for weakness. At that point, we have to take a little bit of a step back and recognize and understand that severe events, again, will accompany a short-term period of no buying, and then ultimately, if this is severe, selling. There's a lot of people saying, is this a crisis? Is this not a crisis? No, it is just a reality. It is an opening of everyone's eyes to recognize that cheap quality collateral is what is needed to keep the markets moving higher. And it's been that way since 2008. And nobody really seemed to realize it until now. And I mean nobody, but the bulk of the narrative. This is the very first time in 5 years since I really started having these conversations that people actually have a kind of a clue what the hell I'm talking about, which is great because that does not go on at home. My wife goes, "That's great, dear," pats me on the head and walks out. She goes, "What do you mean?" And then I explained everything to her like a year ago, and she goes, "Oh, is that why you're worried about things?" Like, wow, no therapy needed, just a deeper understanding of monetary policy. That's what I'm talking about. All right, on top of this, look, this is all about the repo surge and the plumbing under pressure. I'm going to mention what happened with Michael Burry in a minute because this is really the core thing that we are focused on here in the financial system. Overnight repo and SRF, standing repo facility usage elevated. The Fed is adding temporary cash against treasuries to keep the funding pipes flowing. Once again, this is not money printing in the traditional quantitative easing element. However, this is very important, it is the creation of claims. And these claims act like money. It is shadow money. It is the expansion of shadow money. So it is akin to printing money in a world that is not money to most people. Okay? That is a little weird. It's very fourth dimensional. Don't get caught up in it or else your nose will bleed. Rising funding costs create higher rate volatility, equities and credit trade-off liquidity, not just fundamentals. Very important. It is all about capital in the system. Yes, earnings are very important in driving prices higher, but there is a reason why 40% of the Russell 2000 is unprofitable and still alive. There's a lot of money and there's the capacity to expand balance sheets to take on more debt. That is why we live in a world with so many companies that should not be public or should not be around anymore. It's the liquidity, not the fundamentals. We're watching the SOFR, which is the secured overnight financing rate. That is the collateralized. Oh my God, I'm getting way too into the weeds, aren't I? Well, what matters at the end of the day is the fact that the SOFR and the Fed funds rate, don't think about it that way. Think about it as there is a pawn shop down the road and you need money. You need to raise $2,000 today. You have two choices. You can go hawk a ring at a pawn shop using the ring as collateral, or you can go to the mafia, and the mafia will charge you less interest than the pawn shop will. The mafia doesn't care about the ring. The mafia cares about what am I getting back on the interest. That's what's happening. The uncollateralized funds, that is higher than the Fed funds rate, which is uncollateralized. It's like your pawn shop charging more than the person who would break your knees. That is the paradox of where we are. And what this does, and this is the chart from cross-border capital and global liquidity indices, when that figure, that spread, that collateralized number, SOFR, is above the Fed funds rate, you see these orange lines. When it is elevated, particularly toward a 20 basis point spread, that is where stress in the financial market happens. This line right here is the Nikkei crash last year. This line right here is a spasm in the Fed funds and the money markets that happened in December. These recent spikes are all likely tied to private credit, fraud in the financial system. And yes, I've said that. Somebody said this morning on LinkedIn, there's no banking crisis. We literally have evidence of fraud, collateral fraud, where effectively banks did not do a good job of their homework before providing loans. That is a problem. Is it a crisis? No. But once again, we are in an environment of rampant fraud. And that is exactly what happens when this stuff starts to move higher. When the repo markets start to spasm, we start to actually see who those cockroaches are. And some of it's fraud and some of it's just bad underwriting. But these are the things that get in people's heads. And the people who remember 2008 and remember some of the previous crises, they say, wait a minute, is this time different? What's going on? How do I trade this? What's my focus? We're going to dig into that. But it's important that you just understand the broader macro element of this. The TLT, the SHV, the XLF, and the KRE. The XLF is the financials, the KRE is the regional banks, and the VIX is going to be a major player in all of this in the next couple of days. As this is happening, Michael Burry, as you know him from The Big Short, has come out of nowhere. I did not see him on social media for, I think, 2 years. Comes out of nowhere on Thursday with a cryptic post and then announces through a regulatory filing that he has put on a $1 billion bet on the valuations of NVIDIA and Palantir. Palantir's CEO had an absolutely bananas response to all of this, but that said, it's justified. It's a justified bet. But here's the thing. NVIDIA and all of these Mag 7 stocks, they have gone up, 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 up. And fundamentals didn't matter on the way up. So why the hell did the fundamentals matter on the way down? Michael Burry's bet is not against NVIDIA and Palantir. Michael Burry's bet is actually against the Fed. Because if he is fighting NVIDIA and he is fighting these companies with these massive valuations, he has to be betting against cracks in the fundamental structure that has allowed the leverage in these stocks to exist the way that they have for the last 3 years. Burry made a ton of money betting against the housing market back in 2008, but it wasn't the housing prices going down that ultimately led to his profits. It was the collapse in all of the leverage around the ecosystem of housing, including the mortgage-backed securities, and ultimately the fact that they had to mark to market his bets against the housing market. They did everything they possibly could to not mark to market, actually realize the true value, intrinsic value of the decline in the bets that he had made against them. When that finally happened, that's where he made his money. So he needs the crack in the system. We need the SRF to be overwhelmed. He is betting against the confidence and collateral in the system. I'm not saying that this is explicitly what he said. I'm saying that that's the real bet. So once again, there is all this chatter about valuations. Valuations is not what is driving this. The impeccable timeliness of this bet comes at the time that NVIDIA and all these other stocks are at these high levels, but it is the infrastructure and, again, the plumbing of the financial system. If all of that dries up and we have a liquidity event, then don't be shocked if the bet pays off, because every single time that we have a big drawdown like this, these are liquidity events, by the way. NVIDIA fell 33%. It fell 33% last year from that peak in July until that Nikkei collapse. Now, NVIDIA and Palantir have just announced a new partnership, which I cannot believe is coincidence. Okay. we are in, wow. I need to take a breath after that one. Woo. All right. Sure. Why not? Why not? A couple of moving parts real quick before we get to the runner. Negative momentum, weak breadth, shutdown, data vacuum. Again, the mask softness. We have that jobs report. I have not seen it yet. So we'll take a look at that in a second. Shutdown delays, official data. So again, that ADP print is what matters most. Payrolls rolls $42,000 new jobs in October, more than expected, countering labor market fears. Oh boy. All right. That said, that follows a decline of 29,000 in September and topped the expectation. Here's the thing, real quick, just looking across the board on this: education and health services, 26,000 new jobs, but luckily good. Trade, transportation, and utilities adding 47,000. Financial activities adding 11,000. The weaknesses are in business services, other services, and manufacturing. So good, positive jobs report. That's going to be all that we really have to operate on. That may also signal that a jobs cut is, or a cut in the rate is not coming in September or December, meaning that bad news is good news and good news now becomes bad news. Fade the bounces in the weak sector pair trades, again focusing on the Russell and the SPY and looking at the RSP as well. Finally, oil is sliding with that firmer US dollar. We're watching stockpiles and OPEC. We will be back later today with me and Gianni at 3 o'clock. I want to pick his brain a little bit on the energy sector, and he can ask me questions about that if he'd like, and I will be asking him about momentum and some of the other major events that are transpiring in the tech side. All right, it's 9 o'clock. That can only mean one thing. Where are you, Charlie? There he is. Thank you. All right. So, very difficult little environment that we're operating in. I do want to point this out real quick. When we move into this period of chop and, again, negative momentum, I want to be very, very clear that I am explicitly looking for short-term reversions that will potentially lead to some element of upside. So if I'm digging deeper into this and I start to assess some of these names, what I'm looking for on a 5-minute chart, a 15-minute chart, a 4-hour chart, however you assess it, is you're looking for strength on the adjusted EMA. And what I mean by adjusted is you multiply the number of minutes times the duration period of that line. 8 times, again, 5 is 40. 15-minute chart will take you a little bit differently as well. But we can see right now with Goodyear Tire on our on the 15-minute chart that looking stronger, moving over to the 30, looking stronger, moving into the hourly strength. This is more short-term momentum. And right now, with a stock like this trying to rebound, the strength is here. And again, what I'm looking for in this environment, if we start to have a sizable sell-off or a larger sell-off, there's going to be a focus on the things that matter. It's going to be in the defensives and the parts of the consumer cyclicals that are essential. Tires are essential. I'm going to find out the hard way in about 5 hours when I take my car in. Goodyear. Ooh, coughing. Sorry. BTU. Where's my water? That was a lot. Go down to the 1-hour chart. You're seeing strength on the coal side. This has been a very fascinating chart. BTU has been chopping around for the better part of a couple of weeks. Going back to October after that largest sell-off. Lower highs, lower lows, looking to break into positive channel. This is not going anywhere. Coal is not going anywhere. So relatively weak, obviously, on that income side, and we've seen some weakness on a lot of these names, but we're looking for a reversal in momentum. Now, the U.S. dollar continues to remain strong. Coal continues to be under a little bit of pressure. The U.S. dollar currently at 100, but all of the other materials remain, after that huge bull run, in similar fashion. We're heading into the winter, so coal, Basically, the way that I prefer to trade this, particularly from a long-term focus, is selling spreads to the downside. But looking at BTU down at the $22 and $20 level, I need my phone to stop making sounds. I'm going to throw that away, and we're going to continue with our analysis. On the other side, AMD. Look, this was not shocking. This thing has been in an absolute parabolic run for the better part of a month and a half, going back to April when this was at 80 and we effectively triple. Okay. Shares falling after quarterly earnings and issuance of guidance 2.4. Here is your line in the sand, 238.90. We get under that level. I am looking explicitly for moves on the 3 today. We're going to be looking for moves where effectively the EMA on the 20 breaks under the 20 and then it starts to reverse back. This is a volume weighted average price stock to be trading. Looking for reversions, looking for the possibility of moves down into the third to fourth standard deviation, and then bouncing back. BIDU. China remains strong regardless, just so that you know. But this has been under a little bit of pressure. China continues to print. They continue to engage in monetary policy. So right now, as we look at the short term, right, weakness to the downside, I am still looking for potential opportunities if this gets into oversold. So I am looking at the 30-minute chart in this negative momentum environment. There could be leverage that is effectively going to continue to unwind, even though we have this printing. Once again, all signs point toward money printing in China, their monetary base continuing to expand. You could try to short this. If we break under this 50 level on the RSI, we see that the MACD is turning over on the 30-minute chart. Once again, I am looking for oversold on RSI and MFI before making a bid and trying to ride this back up. Finally, K-View. What do you do? Kenview. Consumer defensive. Oof, not good. Weakness across the board, continuing to struggle. I'd be looking for, again, some money to rotate back into consumer defensives after we effectively bottomed out in recent days. If this stock can push to its 1688 and cannot get back above that 50-day moving average, it will be a rollover short for me. Your watch list today, particularly on reversions and reversals, particularly names that we are looking for to potentially bounce off these standard deviation bands and then turn right back around and deliver potential upside trades. It's going to be in the SPY, obviously, right up front. Look, this is where we get into an environment where we see more volatility. We are going to be focusing and anchoring our volume weighted average price to the close from yesterday. Let me put that in real quick. So key line in the sand today for the SPY will be 675.06. Current VWAP at 674.83. Same thing with Amazon. All of these companies today, again, holding above yesterday's closing price. That line, that 284.75, is going to be a very critical level. We're going to look for the today's standard volume weighted average price to align with this as well. What are we talking about this then? Okay, if we break under this level, we're going to look for this to sell off. If we break down into the third standard deviation, we are looking for this to melt back up to either its current standard deviation or that anchored 1 minute VWAP from yesterday. JP Morgan under pressure. Well, again, some of these banks are getting bids. This is why we do these conversations, because a bid up in the morning can quickly lead to a sell-off in the morning as well. Be very cautious and be aware of where these yesterday's close levels were, and recognize that these are core anchors as well. This is every single purchase that has been made institutionally since that close. They are going to be looking to defend that previous day's closing price. And Amazon, we already talked about. Amazon, Apple, and AMD. AMD is obviously the big name today. Once again, already starting the day off strong. We break under that 244.29 level. The next move is down here to the 241.33. And again, we will adjust accordingly. But I do like waiting for a move on the 244.26 on AMD if the market opens for a intraday short and looking for the weakness to persist. All right. Tell that to Jimmy Buffett. Huh? Jimmy Buffett. What's that have to do with anything? All right. So once again, tell that to the Buffett groupie. Oh. What? What are we doing? Don't know if KTOS is in the runner, but I hear the stock. What? What? Yeah, KTOS got beaten up a little bit today. Down to 83. Well, once again, government shutdown ain't going to help too much, but we're going to look at this one because actually KTOS creates an interesting opportunity. If this thing is down the way it is, I might sell some spreads to the downside on KTOS. I am long Kratos defense. It bought Orbit. Well, that explains a lot. That explains a ton. I'm going to sell down here. It's the best, one of the best momentum stocks of the last year. Been long this and talking about this. God, that had to have been like 15 when we were started on this one. All right. So, Brian, what's going on? Yeah, it had a huge run. It was like gold. Everybody's like, oh, gold's crashing. No, gold's fine. Just, it'll be fine. Let it go. It'll be fine. All right. So let's talk about this real quick. Again, when it comes to the S&P 500, we're just going to do this real quick. Poor man's version of this, month down. And I'm going to go out a little further on this, just so you know. I'm going to 7%. Little secret to everybody. Stock's up 7% on the week, down on the month. Or forgive me, up on the week, up on the month, up on the week. Beta over 1. 7 stocks. Amazon, the biggest one, $2.6 trillion. Go the other way. Now, again, the poor man's way, we typically do this is around 5%, but I just want to show you the flows of this real quick. 25. So 18 names. And what's interesting about this is that you basically combine Meta and Oracle and you end up with Amazon in weight. Money is flowing out. It's not monstrous, right? It's maybe net on the extremes, $100 billion to $200 billion, but it's sizable enough. And if you look at what is getting beaten up, it is IT software. Look at these sectors. These are the ones that will continue to bleed. Good companies are getting beaten up. Pool Corporation is an extraordinarily capital efficient business. Sign of the times. Coinbase, well, that's crypto. eBay, that's consumer. The cruise lines are getting hammered. Not shocking. Meta's under a lot of pressure. That's very important, by the way. And DoorDash, right? Consumer focus. So we, on the outside of the bell curves in this negative momentum environment, that is where we start to watch the FNGD to see if this starts to actually break out or if there's just going to be more crowding again in the S&P 500. We're watching that. We're watching the FAS on the bull ETF on banks, trying to hold and get back to its 20-day. It's not there. FAZ is our line in the sand on that. So this is more of a, again, not a unwind yet in the Mag 7. This is really more around the banking sector, private credit. Everybody knows there's a problem. If this momentum continues to break down, if the FNGD breaks out, if we start to see the Mag 7 really start to struggle, I want to remind you right now, cash is your best friend. It is not a bad thing. Look, I understand this, and I want to point something out. Some of you might have owned a company like Kratos, and it might be up 200%, and you might have a 200% gain, and that stock might have been at 112, or, you know, I don't know, 212, and now it's at 170. I'm just numbers in my head. Okay, you're down 20% from the peak. If you're up 150%, you're doing fine. Don't hold out because of what you have lost from the peak. That is a very dangerous thing to do. This is a thing that business owners do on a regular basis, where they have an opportunity to sell their business. They think what the value of it is. They don't get it. They find something. The market changes. Now, all of a sudden, their valuation has dropped 20%, and they say, well, I should hold on, when things can bleed off a lot worse. And now, all of a sudden, you're taking a lower ball deal. Same thing happens in the equity markets, okay? Remember, cash is your friend. So where you can take profits and you can harvest gains right now, and just raise some capital in case this does go negative and really beats up this market and stays there, capital preservation and key technical entry points. There's still opportunity to buy puts and insurance if you need it, but protect capital to buy low and sell multiple, high multiple times per year. Secondly, don't start selling put spreads right now. Last thing you want to do. If you're in put spreads that are a little bit underwater, consider closing them. This is important. This is about capital preservation as well. Unless you want to own a stock, but the reality is if this goes sideways, the stocks that you want to own for a specific price that you pointed out, they may end up being lower than those levels. Now, I'm not saying that we're in the middle of a market crash. All I'm saying is that every time that this signal has gone red, there has been pressure in the market, or policy accommodation ultimately follows. Sometimes it's just a push against resistance. Sometimes it's the beginning of something bigger. And this feels slightly bigger than it is, not because I'm telling you it is, but because it has that hallmark of the Silicon Valley banking event, in that everyone became an expert about banking all of a sudden. And then everybody made runs on their own banks. It was a social media phenomenon. So I want to play defense against the herd. I was reading a great chart, a meme last night that said people who understand history, people who don't know history are doomed to repeat it. People who do read history are doomed to sit by and watch those people repeat history. So in this environment, I'm very cautious. I started taking gains the other day. I started raising cash the other day, and I'm not going to aggressively sell puts on something unless it is way out of the money. And even then, I have to be cautious. I can always redeploy capital. Take profits on winning trades and reassess losing ones right now. Ask yourself a question. If there's something that you bought that still doesn't make sense to you and you don't know what the business actually does, why are you in it? Selling pressure can be indiscriminate. Again, pool corporations getting beaten up today. It's a great business. It's a great business. It's a very highly capital efficient business, but it's getting its head kicked in right now. Learn implied volatility rank. We did a whole thing on this yesterday at the NVIDIA 4D prep. IVR implied volatility rank compares current implied volatility to the last 52 weeks. Under 25 is where options are cheap. IVR over 30 or options can be a little bit more expensive, particularly over 50 is where you want to be selling premium. Maybe you're selling credit spreads to the upside instead of trying to sell put spreads to the downside. Use IVR to decide which stock to trade and which strategy fits, but recognize you have to know why the IVR is elevated. Make sure that there's no earnings event coming up, therefore justifying your trade. Selling credit spreads in a negative momentum environment. Use vertical call spreads when IVR is high, and they benefit if stock trades sideways or declines. The higher call limits upside risk from reversals or buyouts. This is important, okay? I like to sell credit spreads to the upside, but we have to be very, very cautious, again, about the fact that there is policy changes that could shift everything. This is really going to be about the Fed against the standing repo facility, and whether or not if there is cracks, will it be able to handle a lot more demand all at once? Here's the other thing I want to point out. Always look for oversold conditions. And whether you are looking at this on the daily charts for oversold typically do align with bottoms combined with insider buying. This is where I am now backing up the truck, not just to buy, but also to sell spreads to the downside. Very high implied volatility rank. Everything is oversold. People are panicking a little bit, and all I'm looking for is a little bit of a pop that'll allow me to buy these spreads back for a little bit for cheaper than what I sold them for. I want to be very cautious before I make any type of move like that. Look for exhaustion in the selling and look for the point where we really don't have any buyers at that point. Really, in this environment, what we're really focusing on is taking advantage of what the technicals give us. You have to be very, very patient in this environment. So once again, if we get back into positive momentum, we get back above our 8-day moving average, that could mean anything. That could be policy, that could just be confidence, that could be a trade conversation. There's a lot of things. Right now, it really is about exercising caution, but again, focusing specifically on the optimal type of trades that will benefit. And again, we're shorting. Look at the inverse side, SH, look at the inverse Qs, look at some of the day trading around things like the NVIDIA leveraged ETF so that you could short these things using volume weighted average price and bring your focus in instead of daily charts. Look on the SPY, look at in individual stocks, look for exhaustion on the 30-minute chart on the RSI and the MFI, and then be willing to follow the contrarian path back up. Because again, markets do not just go straight down. They take a stair step pattern down, lower highs, lower lows in this environment. Finally, very specific conditions. When you get to those oversold periods with high volatility, that's where you want to target the great companies. Occidental was a company that I sold put spreads on forever when we got into oversold territory on oil. IVR on TOS is... actually had this question yesterday. You have to go to let me find the chat. All right. In the option chain on the trade tab, enter the ticker, click the small layout drop down, choose volatility to customize the layout. There should be a column that you can add for IV and IV percentile. In the charts tab, go to studies, edit studies, and search for IMP volatility, IMP volatility, and add the chart to visualize. Okay. I'm going to put that in the chat. Ooh, ChatGPT. There you go. Cool. No buyers means no buying pressure. So what that means is, again, when we assess momentum, we're looking at the number of stocks that are in breakout versus breakdown territory. Specifically, what I mean is that there is no buying pressure. There are no stocks that are up 5% in a week, up in the month, high beta. That happens. That's typically where we end up seeing short squeezes. They're very short term. They might last a week to 2 weeks. But back on March 12th, I was beating the hell out of the drum on that Monday, just saying, guys, there's no buying pressure. Look for the sellers to stop selling. They're exhausted, and they're going to basically. We had a short squeeze that led us into March 26th, and then the second that we broke back under that 20-day moving average, all the funds sold right back into pressure, and that led to that sell-off. Same thing happened back here in August. Again, oversold, policy change, market took off. So we'll dig into this a little bit later today. I write about it virtually all the time. But be very, very cautious in this environment. Don't try to force anything. Instead, be very, very patient. Look for setups. Look for things. Don's talking about Christmas trees, talking about Tony and the golden setup. You got to be patient. You got to let the market bring the opportunity to you. And that is where you can take a lot of advantage of these markets. While everybody else is panicking, you react, and you react to exact setups as they come. Guys, I hope you have a great day. I got to hand it off to Don before I get yelled at. He wants to listen to his music. I get it. I hope you guys have a great day. I will catch up with you today, 3 o'clock, me and Gianni. Sounds like a fascinating book about touring Italy. Take care. Bye.